Right now, while you are watching this, someone somewhere is being reported for using their own money. No crime committed, no warning given, no police at the door, just a transaction, a pattern, a number on a screen that software did not like, and the person being reported may never know. It happened. At this same moment, another family believes every dollar in their savings account is protected. They trust the logo on the bank window. They trust the system. They trust what they were told for years. But trust and coverage are not always the same thing. Somewhere else, a digital payment is moving across the country in seconds. 24 hours a day, 7 days a week. No closing bell, no weekend pause, no waiting until Monday morning. And millions of people using the financial system every day have never heard the name of the network carrying their money. This is not theory. This is not fear. This is not fiction. These are real policy shifts, real reporting systems, real rules already active, quietly introduced, barely explained, rarely understood. And if you have a bank account, savings account, payment app, credit union account, investment wallet, crypto wallet, or cash stored somewhere private, this affects you because while most people were busy working, paying bills, scrolling headlines, and assuming yesterday's rules still applied, the rules changed, not all at once. One threshold here, one reporting requirement there, one digital rail launched in silence, one definition expanded. In a regulatory filing nobody reads. Each change looked small on its own, but together they form a picture. A picture most people never stop long enough to see.
Thank you.
Tonight we begin with one question.
One moment.
What happened to your money while you were not looking? And more importantly, what can you still do about it legally right now? Because there is one truth. Almost nobody learns early enough. The time to understand financial rules is before they show up in your life, not after. By the time a policy reaches your account, your transfer, your withdrawal, your tax notice, your frozen funds, the lesson has already become expensive. So we start with the first rule, the one most people think they understand, and the one that catches people every single day. Rule 1. The cash myth. Ask almost anyone how much cash triggers a bank report, and they will answer quickly. $10,000. That number is famous. It has lived in conversations for decades. People whisper it like secret knowledge. Stay under 10,000 and nobody notices. Stay under the line and you are invisible. That belief has ruined many people because the famous number is only one part of the story. Yes, certain large cash transactions can create mandatory reports. That part is true. But there is another system that matters just as much, sometimes more. And it does not begin at 10,000. It begins with behavior, patterns, timing, frequency. What looks unusual, what looks inconsistent, what looks like avoidance, even if the person had innocent reasons. Imagine someone withdraws cash several times in 1 week. Perfectly legal amounts, ordinary money, personal reasons, maybe paying workers, buying equipment, helping family, preparing for travel, making a private purchase to the person. It feels normal. To software, it may look like something else, and software does not know your story. It knows data, dates, amounts, locations, sequences, changes in habit. That is the modern shift most people missed. The move from watching numbers to watching behavior. A single large transaction can attract attention, but a strange pattern can do the same, sometimes faster, sometimes without the customer ever knowing. No phone call, no letter, no alert in your banking app. Just an internal report filed behind the scenes. And this matters because people often try to be clever. They think smaller is safer. Split it up. Do it slowly. Move beneath the radar. But trying to look invisible can look more suspicious than being direct. That is the trap. The system often reacts not only to size, but to intent, or what it believes intent might be. So what should a normal person do?
I can't believe this is
First,
happening.
stop thinking in secret tricks. There is no magic amount that guarantees invisibility. Second, if you need legitimate cash for a legitimate reason, be straightforward. Use normal banking behavior. Keep records. Keep receipts. Be consistent. Third, understand that your bank is not only a place that stores money, it is also a compliance machine that is not evil. That is how modern finance works. Banks manage risk. Regulators demand reporting. Algorithms scan behavior. And ordinary customers sit in the middle of all three. Many people only realize this after they feel questioned, after a transfer delay, after an account review, after a request for explanation. By then, the lesson is already personal. The bigger shift. The old world cared more about what you did. The new world also cares how you do it. That difference sounds small. It is not. Because millions of ordinary people are not criminals. They are simply unaware that systems judge patterns now, not just totals. And once you understand that one fact, you begin seeing the rest of the system differently, which brings us to the second illusion many people trust without checking. The idea that if your money sits quietly in the bank, it must be fully safe. That depends on how much, where it sits, how it is titled, and what kind of failure happens. Most people never learn the details because they assume safety is automatic. It is not always automatic. It is structured, and anything structured has limits. The trust symbol. Walk into almost any bank, and you will see symbols of confidence, clean floors, calm staff, strong logos, language of security. People associate banks with certainty. Your paycheck arrives there, your savings grow there, your bills get paid there. The relationship feels permanent, but institutions are still institutions. They can merge, shrink, freeze operations, face stress, close branches, fail under pressure. When that happens, rules matter more than branding. Coverage categories matter more than slogans. Ownership structure matters more than emotion. Yet millions of people could not tell you how much of their own money is protected under different account setups. Single account, joint account, trust account, retirement account. Different structures can change outcomes significantly, but average depositors rarely ask until a crisis is on television, and panic is the worst time to begin learning. Basics. Why people ignore this? Because normal life trains people to ignore invisible systems. If the card works, if the app opens, if the ATM dispenses cash, if direct deposit arrives, everything feels fine. Convenience creates confidence. But convenience can hide complexity. That is why so many major rule changes arrive quietly. Most people do not read policy bulletins. They do not monitor federal registers. They do not compare definitions year to year. They trust continuity. And continuity is exactly what regulators know, people assume. So updates happen in the background, one by one, quiet enough to avoid outrage, technical enough to avoid headlines, important enough to change lives later. The new financial reality, money today, is not just stored value. It is data. Every movement can become metadata. Every account can sit inside layered rules. Every convenience tool can create a record trail. Every misunderstanding can become expensive. This does not mean panic, it means maturity. Serious people learn systems before systems test them. That is how wealth survives quietly, while others stay confused. What you should do this week, do one simple thing. Look at every place you keep money. Bank, credit union, brokerage, payment apps, cash locations. Ask yourself 3 questions. What are the rules here? What are the limits here? What assumptions am I making without proof? That exercise alone puts you ahead of most people, because most people never audit assumptions until reality does it for them. What comes next? In the next part, we move deeper. We expose the safety net. People trust, but rarely understand. Why deposit protection is not as simple as people think. Why extraordinary rescues are not promises, and why large balances in one place can create silent risk. Then we uncover the real-time payment system, moving money faster than ever before. A system millions use without knowing its name, and what speed changes about privacy. Stay ready, because the next rules are bigger than cash. Most people do not study bank insurance until how money moves itself. That is human nature. When life feels stable, nobody asks difficult questions. Money sits in the account. Cards keep working. Transfers arrive on time. Statements look normal. So the mind assumes protection must be complete. But complete protection and limited protection are not the same thing. And many depositors discover that difference only after fear enters the headlines. For decades, people were taught a simple message. Money in the bank is safe. That statement contains truth, but it also contains missing details, because protection is built through categories, limits, ownership types, institution status, and the specific way a failure unfolds. Those details matter more than slogans. Ever will, the comfort of a logo. Person sees a government insurance logo in a branch window and feels calm. That reaction is understandable. It signals oversight, rules backstops, history, trust. But symbols can create lazy confidence. People stop asking, how much is covered? They stop asking whether multiple accounts are treated separately. They stop asking what happens above certain limits. They stop asking how quickly funds return during a failure. They stop asking because the logo did the emotional work, and emotion is often stronger than knowledge. The common mistake. A saver builds wealth slowly over years. Long hours, disciplined sacrifice, missed luxuries, extra shifts, careful budgeting. Eventually, savings become meaningful. Maybe 300,000, maybe 500,000, maybe more. The saver feels proud and secure because money is in a respected institution. But the real question is not how proud the saver feels. The real question is how the accounts are structured. Single ownership can be different from joint ownership. Retirement categories can differ from regular savings. Trust structures can change coverage. Two people with the same balance at the same bank may face very different outcomes based on paperwork alone. That sentence shocks people because it feels unfair. Yet systems often reward structure more than emotion. When failures hit the news, whenever a bank crisis becomes public, the same pattern appears. Crowds gather online, rumors spread faster than facts. People ask if their money is trapped. People ask if all balances are protected. People ask if the government will step in. Sometimes extraordinary actions happen. Sometimes emergency guarantees appear. Sometimes officials calm markets quickly. And then a dangerous belief forms. People assume every future crisis will be handled the same way. That assumption can become expensive, because emergency actions are often responses to unique moments, not permanent promises. A rescue once does not equal rescue always. An exception is not a rule, but average citizens often confuse the two. Why this matters now? Confident systems rely on trust. Banks need depositors to feel calm. Markets need citizens to believe access remains stable. Governments need panic contained. That means messaging during crises often focuses on reassurance. Reassurance has value, but reassurance without education creates future confusion. If people hear only that everyone was saved once, they may ignore limits forever. They may keep oversized balances concentrated in one place. They may assume outcomes are guaranteed. They may never diversify. Then the next stress event arrives under different political pressure, different market conditions, different decision makers, and assumptions meet reality. The smart way to think, do not think in terms of one account. Think in terms of systems. Where is your money located? How many institutions hold it? What ownership categories exist? How quickly can you access alternatives if one system freezes? How much cash flow depends on one bank? How many automatic payments rely on one account? These are adult financial questions. Most people never ask them because daily life rarely forces the issue, but resilient people ask before pressure begins. The silent risk of concentration. Concentration feels efficient. 1. Bank 1. Login. One statement. One familiar branch. Simple life. But concentration creates a single point of failure. If access freezes temporarily, if fraud locks the account, if identity verification delays transfers, if technical outages hit, if institution stress creates restrictions, then convenience becomes vulnerability. Diversification is not only for investments, it can apply to access itself. Two institutions can be stronger than one. A bank and a credit union can be stronger than only one channel. Multiple. Rails reduce dependency. The psychology of normalcy, people assume tomorrow will resemble yesterday. That bias comforts the mind, it also blinds it. Most dangerous events in finance are ignored until the week before they matter. Not because nobody warned anyone, because warnings felt boring during calm periods. This is why so many citizens become experts only after a problem already touches them, after a frozen card, after delayed payroll, after transfer limits, after branch closure, after panic headlines. Preparation always feels unnecessary until suddenly it feels brilliant. What a wise person does. Wise Saver reviews account structure annually, checks beneficiary designations, understands ownership categories, knows exact coverage boundaries, maintains at least one, secondary institution tests, access methods before emergencies, keeps updated records, uses calm seasons to solve future stress. That is how grown financial behavior looks. Quiet, unexciting, effective. The speed problem, even when balances are eventually safe. Access timing matters. Bills arrive on schedule. Rent expects no sympathy. Payroll dates do not pause for system stress. Mortgages keep their calendar. So the issue is not always loss. Sometimes it is delay. And delay can break people who technically still own their funds. This is why liquidity planning matters. Small emergency reserves outside a primary institution can reduce panic dramatically. Not because disaster is certain, because friction is common. What the public misses, they focus on collapse stories. But everyday disruptions happen more often than collapses. Temporary fraud holds, verification freezes app outages, transfer reviews, debit card replacements, identity checks. None of these make national headlines, yet each can disrupt ordinary life. People who depend on one channel feel trapped quickly. People with multiple channels adapt quietly. The next shift. While depositors focus on where money sits, another revolution has been happening in how money moves. Real-time settlement, instant transfers, always on networks. No waiting for business hours. No weekend pause, money moving with the speed of messages. Most consumers celebrate convenience and stop there, but speed changes more than convenience. It changes expectations, tracking behavior, patterns dependence. On digital rails and the shadow every transaction leaves behind, millions are already using these systems without understanding the infrastructure beneath them. That matters. Because when rails change, money itself begins to feel different. One action. This week, call your primary institution, ask 2 questions. What is my exact coverage based on current account titles? How quickly could I access funds during a disruption scenario? Most people never ask. Either question, asking them alone raises your awareness. Most people think money moves because they tap a screen. They open an app, press send, see a confirmation message, and believe the story ends there. To the average user, the transfer feels simple. 1 second the money was with them, the next second it was somewhere else. Clean, instant, effortless. But beneath every smooth transaction sits infrastructure. Rules, networks, settlement systems, data records, institution permissions, timing controls. The visible part is convenience. The invisible part is power, and modern finance has been shifting rapidly towards speed faster than many people realize. The old world of slow money. There was a time when money moved with friction. Transfers took days. Weekends slowed everything. Holidays created pauses. Checks needed clearing deposits. Needed processing banking hours mattered. Delay was normal. People complained about it. But slow systems had side effects people rarely appreciated. They created breathing room. They created time to reverse mistakes. They created moments where movement was less constant. They created limits on how quickly panic could spread. Speed removes many frustrations. It can also remove buffers. The new expectation. Now people expect movement instantly. Salary alerts, immediate transfers, late-night payments, weekend settlements, real-time confirmations. If money feels delayed, users call it broken. That expectation changes behavior. People hold less patience, less emergency planning, less tolerance for waiting. When systems become instant, citizens become dependent on instant systems, and dependence is rarely discussed during convenience marketing.
They actually approved it.
Chai rails matter. Most people study the app interface. Few study the rails beneath it. But rails decide what is possible, how fast funds move, what data attaches to transfers, how disputes are handled. What hours matter, who can participate, what records remain. The rail is the road. The app is only the car. You may love the car and know nothing about the road, yet the road controls the journey. Every digital transfer creates a shadow cache, changes hands quietly. Digital. Money usually leaves traces. Sender-receiver amount, time, location patterns, device patterns, behavior sequences. This does not automatically mean danger. It means visibility. Visibility can help stop fraud. It can help resolve disputes. It can help investigate crime. It can also mean your financial life becomes easier to map than previous generations ever imagined. The modern citizen often trades privacy for convenience without noticing the price, the psychology of free convenience. When something feels free, people ask fewer questions. Instant transfers feel free, tap and done, but systems are paid for somehow, sometimes through fees, sometimes through data value, sometimes through dependency, sometimes through future optionality. The platform gains later, if millions. Cannot imagine life without the rail. The rail gains leverage. That truth applies across industries. Finance is no exception. Cash feels different for a reason. Cash is physical. It can be lost, stolen, damaged, inconvenient, heavy at scale, but it has qualities. Digital systems do not naturally copy immediate possession. No password required, no app outage risk, no battery dependency, no network dependency, no digital trail in the same way. This is why debates about the future of cash are never only about efficiency. They are debates about autonomy. When all money becomes purely digital, access itself can depend on permissions beyond your control. That possibility is why serious people pay attention early. The always-on world real-time rails create a 24-hour money environment. No closing bell, no natural pause. This sounds excellent until you consider human behavior under stress. Rumors now travel instantly. Fear now reacts instantly. Mass movement can happen instantly. Fraud attempts can happen instantly. Pressure no longer waits for Monday morning. The same speed that helps families can accelerate panic in fragile moments. Technology solves one problem while creating another. That is the pattern of progress. The data value of habits, one transfer, says little thousands. Of transfers reveal patterns. Where you spend, when you travel, how regularly income arrives, how stable bills appear, what subscriptions exist. How behavior changes during stress patterns are often more valuable than isolated transactions. Modern systems increasingly understand patterns better than people understand themselves. That is not science fiction. It is analytics. People miss this because convenience hides architecture. Nobody celebrates plumbing until water stops flowing. Nobody studies payment rails until transfers fail. Nobody asks deep questions during smooth operation. The public wakes up when outages happen, when accounts freeze, when fraud spikes, when terms change, when limits appear. Until then, invisible systems remain invisible. The future question, the biggest future debates may not ask how much money you have. They may ask how programmable money becomes. Can categories be restricted? Can limits change dynamically? Can permissions tighten during emergencies? Can incentives steer behavior automatically? Many forms of these ideas are discussed globally in different ways. Whether they arrive slowly or never fully materialize is less important than one truth. The technology direction is already visible. When rails become smarter, money itself can behave differently. What a wise person does now use convenience but understand trade-offs. Maintain multiple payment methods, keep some liquidity outside one app. Ecosystem. Know how to function during outages. Retain at least some optionality beyond one digital channel. Read policy. Debates before they become defaults. Do not become helpless if one platform fails for 24 hours. Resilience often looks boring until disruption arrives. The human side of speed-fast systems change emotions too. Waiting once forced patience. Now. Delays create anger. Quickly expectation. Inflation is real. If someone cannot access funds for 6 hours today, it feels like injustice. Years ago, it felt normal. This psychological shift matters because frustrated citizens make rushed decisions. Scammers. Understand this. They weaponize urgency, fake alerts, fake freezes, fake account warnings, fake payment reversals. The faster society moves, the easier urgency sells. Calm becomes a competitive advantage. What comes after? Speed once movement becomes instant. The next frontier is categorization, tax visibility, threshold reporting, automated mismatch, detection behavior, scoring, cross-platform linking. Not always sinister, sometimes efficient, sometimes protective, sometimes excessive. The line between useful oversight and invasive overreach is often argued after systems are already live. That is why informed citizens watch early one's simple test. Ask yourself this question honestly. If all digital transfers failed for 72 hours, how would you function? Bills, food, fuel, family. Support. If the answer is panic, then your system is fragile. If the answer is inconvenient but manageable, then you are stronger than most. The next rule. Movement is only half the story. The next shift targets not speed, but reporting. Small personal transfers. Friend. Reimbursements, side income confusion tax, forms many people never expected to receive, money sent casually becoming visible formally. What once felt like pizza money can become paperwork money, and millions will learn that lesson too late. Most people do not think of small transfers as financial events. They think of them as life-splitting, dinner paying a friend, back-sending rent, share, helping family, covering tickets, sharing travel costs, replacing cash with convenience. Simple moments, normal moments, forgettable moments. That is exactly why the next shift catches so many people off guard, because what feels casual to the user can look formal inside a reporting system. The APPARA of everyday money payment apps changed habits fast. No need for exact change. No need for cash in a wallet. No awkward waiting for reimbursements. One tap and the problem disappears. People began moving money more often because movement became effortless. Tiny transfers multiplied. 10 here, 30. There, 75. Later. Over months, these small moments create large totals. But users rarely track totals because each transfer felt trivial at the time. That is human nature. We remember big payments. We forget repeated small ones. Systems often do the opposite, the difference. Between life and income. A friend pays you back for food, That is not income in the way most people think. A roommate sends utility share. That feels like reimbursement. Family returns borrowed money. That feels personal, yet platforms and reporting frameworks may first see amounts before stories data, before context numbers, before intent. This is where confusion begins. The user thinks, everyone knows what this was. The system thinks, explain it if asked. That gap creates stress. Later. Why small thresholds matter. People pay attention to giant numbers. They ignore smaller thresholds because small numbers feel harmless. But smaller thresholds capture ordinary people, not just businesses, not just high earners, not just professionals. Ordinary people with normal digital habits can suddenly enter reporting territory simply by living through apps. That is the silent revolution. Finance moving from exceptional monitoring toward everyday monitoring, not dramatic enough for headlines, large enough to change behavior over time. The memory problem. Months later, if someone asks you to explain dozens of transfers from last spring, could you do it clearly? Would you remember which payment was dinner, which was sold furniture, which was shared rent, which was a gift, which was repayment? Most people would guess, and guessing is weak when documentation matters. That is why modern adults need records more than previous generations did. Not because everyone is under suspicion, because memory is unreliable and systems are literal, personal, and business lines blur faster. Person sells an old chair online, does some freelance work, once gets paid for helping with design, receives reimbursements from friends in the same account. Now one payment stream contains multiple realities: personal, commercial, occasional, side income, random reimbursements. To the user, it feels convenient. To future paperwork, it can become messy. Clean separation early prevents confusion. Later, most people choose convenience first, then regret, later complexity. The cost of sloppy systems. People think the danger is taxes alone. Often the first pain is time hours spent searching messages, downloading histories, calling support, explaining categories, reconstructing old events, stress before sleep, fear of making mistakes. Complexity itself becomes the penalty even when nothing illegal happened. That is why organized people quietly win. They reduce friction before friction appears. The culture shift. Older generations used cash for many social moments. Cash leaves fewer digital breadcrumbs. Modern generations use apps for nearly everything. Shared lunch, taxi, split gift, pool, vacation expenses, birthday collections. Convenience creates records by default. This does not mean stop using tools, it means understand tools. Create archives, and archives sometimes matter. Later, why people feel angry? Because emotionally they believe, this was my private life, not business, not profit, not a financial event. That feeling is understandable. But systems do not experience feelings. They process categories. If citizens want fairness, they must often adapt behavior to categories that already exist. Waiting for systems to understand nuance automatically is risky. What smart users do: one account mainly for personal social transfers, use another for sales, freelance, side work, or recurring commercial activity. Label transactions clearly where possible. Save screenshots annually. Export histories periodically. Keep simple notes for unusual larger transfers. These habits feel boring. They become powerful when questions arise later. The shame trap. Many people avoid organizing because they feel behind. They tell themselves serious adults already know this stuff, so they ignore it longer. That is a mistake. Most people are improvising. Few were formally taught modern money hygiene. Learning now beats pretending later. The deeper trend. The real trend is not one threshold. It is the direction. More visibility, more automation, more data matching, more expectation that citizens maintain their own evidence. That trend touches taxes today. It may touch other systems tomorrow. Understanding direction matters more than memorizing one number. A simple reset plan. This week, review your payment apps. How many accounts do you use? What types of money enter each one? Can you distinguish personal from business? In minutes, if not simplify. Now create cleaner lanes. Future. You will be grateful. The psychology of digital casualness. When money feels like messages, people treat it casually, but money remains money even inside chat bubbles. The interface changed. The consequences did not disappear. This is one of the defining illusions of the app. Age-friendly design can hide formal reality. What comes next? Many people accepted visibility in apps because they thought alternative assets were freer, harder to track outside the old system, independent. That belief fueled a movement into digital assets and crypto. For years, many assumed it existed in a gray zone beyond traditional reporting logic. That gray zone has been shrinking rapidly, and millions are about to learn what happens when a new asset class meets old reporting instincts. One action this week: download your transaction history from every payment platform you use, store it securely, review categories, clean up habits. You do not need panic, you need order. Order defeats confusion. The next rule. The next shift is bigger than dinner money. It involves exchanges, wallets, gains, losses, basis records, and a generation of users who entered fast markets without building clean paperwork habits. When reporting catches up, chaos often follows. For years, digital assets carried a special aura: freedom, speed, independence. A world outside old institutions. Many people entered that world believing two things. First, that opportunity was unlimited. Second, that rules were unclear enough to ignore until later. That second belief created a generation of messy records, and messy records become expensive when systems mature. The gold rush phase. When new markets appear, people focus on upside prices rising fast, stories of overnight gains, friends making money screens, glowing green momentum everywhere. During those seasons, almost nobody gets excited about bookkeeping. They care about entries, exits, next coins, next runs, next pumps, not spreadsheets, not transaction logs, not basis calculations, not future reporting. That is normal. Human behavior. Excitement crowds out discipline. Why records matter more than people think. A gain is not only what you sold for. It is often tied to what you paid when you entered, how you acquired it, what fees were involved, what swaps happened in between, whether rewards were received, whether assets moved across platforms, whether tokens were converted multiple times. Without clean records, even honest people struggle to explain outcomes later, and confusion can become costly. The platform illusion. Many users assumed the exchange would remember everything forever. Some platforms closed, some merged, some restricted access by region, some lost histories, some changed interfaces, some removed easy export tools. Years later, users discover their memory of trades is stronger than their evidence of trades. That is a dangerous place to stand. The culture of latery will organize later, I will calculate later, I will deal with taxes later, I will download history later. Later is the anthem of unprepared investors. Later becomes painful when forms begin arriving now. Why this shift is bigger than crypto. This is not only about one asset class, it is about a pattern. Whenever a new frontier grows large enough, old systems move toward it. At first, innovation runs ahead. Then institutions catch up. Then reporting frameworks tighten. Then casual participants feel surprised. History repeats in different costumes. The hidden cost of many small trades. Some users made thousands of tiny moves. Buy here, swap there, move funds, try yield tools, bridge assets, collect. Reward cell fractions repeat. It felt playful in the moment. Later, each click can become part of a larger accounting puzzle. Many small decisions create one large paperwork. Burden profits can distract from liability. Someone may feel rich on screen portfolio. High charts exciting, but if they do not understand obligations attached to transactions, they may celebrate numbers that are not fully theirs to keep. This has happened in many markets across time. People count gross wins before net realities. Wise participants think after costs from day one.
Welcome. Please.
The emotional phase. Change bull markets create greed reporting seasons, create anxiety. The same person who felt fearless during rallies can feel overwhelmed when trying to reconstruct history months later. This emotional swing is common. It is why mature investors build boring systems during exciting times. The self-custody confusion. Some believed moving assets away from exchanges erased complexity. Sometimes it only changed where complexity lived. Wallet activity still creates histories, addresses, still create trails time, still matters, values still matter, records still matter. Technology can decentralize custody without decentralizing consequences. What smart people do now? Collect statements while they still exist, export. Trade history from every platform, used save wallet transaction lists, record approximate acquisition costs. Where exact data is missing, use one secure archive location. Build order from old chaos gradually, not emotionally. Methodically, the shame barrier many. Users avoid fixing records because they fear how bad it looks. Too many trades, too many mistakes, too much missing data, so they freeze. Freezing extends, pain progress reduces it. Even imperfect reconstruction started today is stronger than denial extended. Another year. The bigger lesson. Every financial era creates citizens who mistake novelty for exemption. New technology does not cancel accountability. New interfaces do not erase obligations. New jargon does not remove mathematics. Eventually, value touches. The same old questions: who earned what? When? How much can it be supported with evidence? The privacy myth. Some enter digital assets seeking invisibility, but many activities still pass through on ramps, off-ramps, exchanges, apps, or public ledgers in ways more traceable than they first assumed. Privacy conversations are complex, but one simple truth remains: assumption is dangerous. Know what is private. Know what is public. Know what is recorded. Know what is guesswork. The cost basis trap. Among all technical concepts, one simple issue destroys many people quietly. They know sale price. They forgot purchase price. Without entry, knowledge exit numbers lose meaning. The person remembers making money, but cannot prove how much. That gap can multiply stress rapidly. A simple reset. Plan. Make a master list of every platform ever used, every exchange, every wallet, every broker, every old email tied to registrations, then recover what data you can. One source at a time. Order returns slowly. Why this matters even if you left. CryptoSome. People think I sold years ago. I am done. Past activity can still matter if records were never cleaned. Ignoring old chapters does not always erase them. Sometimes silence only delays confusion. What comes next? People assumed valuables outside. Digital systems were safer. Gold in boxes, documents in vaults, jewelry in locked bank basements. Family papers hidden behind steel doors. Many still believe physical storage means certainty. That belief deserves a hard look, because some of the oldest symbols of safety are becoming weaker. Quietly. One action. This week, choose 1 hour. Use it to gather every financial record you have ignored. Not everything at once, just 1 hour. Momentum matters more than perfection. The next rule. The next shift is physical vaults boxes, access branch. Closures unclaimed property, and the uncomfortable truth that locked does not always mean protected.